Hello everyone, welcome to Trading Corner. Today we are going to discuss about a portion of fundamental analysis, that is PE ratio, which is also called the price to earning ratio. Uh, Actually, what happened? We become confused, right? Before investing in a stock for a longer period of time, because we saw some of our family members, some of our relatives, some of our friends faced an amount of loss or faced a huge loss during their investment time. But we never asked them why they faced loss. There are multiple reasons through which they faced losses. First one is they were unable to identify the market opportunity and industry growth. Which industry is growing year after year? Where the actual opportunities are waiting for me? Is there any future perspectives that there are not? And after analyzing the market opportunity and industry growth, what we choose some of the leading organizations who are really reliable from that growing industry. So if we do this multiple fundamental analysis, then we can say our investment growth will be the far better than the other, right? So now going with the one of the portion, that is a P ratio. So what is a P ratio? Is a price to earning ratio, which is nothing but how many times you are ready to pay as compared to the company earnings. Here you should know about the EPS. What is the EPS? EPS is nothing about the profit after tax divided by total number of shares. You can say that why you are giving the formulas. Yes, is a profit after tax. Every company earned an amount of profit in every year, and it changes. It can be lesser than the previous year. It can be the more than the previous year. So every company earns an amount of profit, and after that they are giving the taxes to the government. So finally the company have a final amount which they are showing in their balance sheet. So that is the profit of tax. And the company allotted the number of shares in the market, which we call the total number of shares. So if we divide the profit after tax divide by the total number of shares, then we got the earning per share, that is 20 as per our example. And how we calculate the PE? So we calculate the PE by the current share price divided by the EPS that we calculated. So here we got the 10. So that means we are ready to pay 10 times more, right? 10 times more as compared to the earning. Now the question is it good? Is it 10 times is good or bad? So should we take how we take the decision from this 10:1, right? So there are a lot of other angles where we should focus on. So other angle means if we choose a single industry, where the growth is increasing year after year, from 2018 to 2021, the industry growth increasing. So let's say we choose the IT industry, where the industry growth increasing from 2018 to 2021. And we choose the TCS as one of the company who are leading the IT industry. We can do the comparison between the two organizations who are closely related with each other. Then we can do the analysis, the P ratio between these two organizations, whose P ratio is more or less, whose earnings are more and less. But some of the news channels, some of the articles, some of the social media channels will tell you if the stock is cheaper, then be ready with your investment. I will say no. Why? Before before doing the analysis, before doing the analysis of the P ratio, before doing the analysis of the profit and loss, the company's earning, company's balance sheet, don't do the investment. Don't waste your money. Okay, so now here I choose the two company, the company X and company Y. Okay, here company X, whose earning is increasing year after year, and companies Y is increasing year after year. But we can see the company X earnings changes from year 1 to year 2 is 150%, where companies Y earning changes year 1 to year 2 200%, as well as company X earning changes 160% from year 2 to year 3, as well as companies Y earning changes near about 250% to year 2 to year 3. That gives a proper indication that company Y is far better than the company X, right? Why? Because the changes, the mode of changes is far better than the company X. Companies Y mode of changes is far better than the company X. So our first indication company Y gave us that this investment will be the good. But should we invest now? No. What should we do? Now we checked the company earning. Now we will check the company's P ratio. If the company's Y P ratio is higher than the company X, then should we invest? If the company's Y is P ratio is more, then also you can invest here. Why? Because the people who are available in the market, they're ready to pay that multiple times, the multiple times more to the company Y, because it's one of the leading organization, where company X has made some correction in their stocks or in their profitability. So thus company's X is a little bit lower than the company Y. So I will say you that if the company, if any company's P ratio is higher, that doesn't means if any company's P ratio is higher, that doesn't means you can't enter in that particular stock. If the company's earning is far better than the others, then you can. So after doing the P ratio analysis and the company's earnings analysis, we will do the sector-wise analysis. How? The TCS and the Infosys, who are closely related, who are the competitor of each other, and they're under the IT sector. So here we do the IT sector PE, that is a 40.73. And we can see the P ratio is increasing for both the companies. In the recent time, company TCS have the P ratio of 34.79, which is a closely related of the total IT sector P. That means the TCS is one of the leading organizations in the IT sector. As well as Infosys is also near about the 30, which is not so much closely with the IT sector, but it comes to the second position. Okay, so now after doing the sector-wise P, what we do? We do the profit and loss analysis. Here we can see that the TCS profit and loss is increasing. Okay, TCS profit and loss, profit after tax is increasing year after year, as well as the Infosys profit after tax increasing year after year. So for both of these two companies, profit after tax is increasing by the same percentage. Okay, so at that point of time, where should we focus? We should focus on the P ratio. Which company's P ratio is higher, as well as which company is giving more dividend to us. If the company's P ratio is higher, that means more people are relying on this company, and more people are ready to pay that amount to the company as well. Okay, that many times amount to the company as well. So this is our total analysis, total fundamental analysis of the P ratio. We will create another video where we will discuss more about the P ratio as well in the near time. So if you like this video, please like and subscribe our channel and join our channel, Telegram channel. I gave the link in the video description, or you can search a trading corner in the Telegram and join our free Telegram channel as well.